Most price action doesn't trend, it ranges. In the long sideways middle, where price chops for weeks and volume dies, is the part most teaching skips. Today we read one full cycle through that middle, from a breakout to a range to the single sweep candle that resolves it. The real lesson is patience. The chart opens with a bullish push that closes above the prior swing high, the break of structure. The detail that matters. The label marks the candle that closed beyond the level, not the one that wicked through it. Wicks are tests, body closes are confirmations. And the volume on this candle is only modest, a quiet hint about what's coming. From the break, price climbs in textbook structure. Higher high, higher low, higher high, a clean rhythm. This is the markup phase, and in real markets, it lasts the shortest time. Watch the volume across these pushes. The first impulse decent, the second more, the third a spike, but the spike of climax, not continuation. The highest high on the chart prints here. On structure alone, just another high. But read with volume, it's different. A long upper wick on elevated volume. The signature of climax exhaustion. Buyers came in hard, met heavy selling, and got rejected by the close. High volume, long upper wick at the highest high of the cycle is the most reliable exhaustion signature there is. Price drops sharply, breaks the prior higher low, and prints the first lower low of a new structure. Once a lower low prints in a bullish chart, the character has flipped to bearish. Notice the velocity. The decline is fast in few candles. Fast declines skip the retests slow ones make, because the supply is too aggressive to allow recovery. Speed is a proxy for distribution intensity. The decline halts at the lower green line, the demand line that becomes the key reference for the rest of the chart. Price prints its first lower low just above it, and the line starts acting as support. This is regret buying, late traders bidding the first pullback. But their stops sit just below this line, and a pool of stop orders is now forming beneath it. Across the middle of the chart, price returns to that line again and again, printing another lower low at roughly the same level each time. This is the pattern called equal lows. Each one stacks more resting stop orders just below it, sell-side liquidity. From the institutional read, it isn't coincidence. It's built. Each retest keeping retail convinced the bottom is breaking while the stops accumulate. Now look at the volume panel through this whole middle against the markup on the left. The bars are dramatically smaller, consistently compressed. Activity has died. Volume contraction inside a range is the signature of a range maturing toward resolution. Committed sellers have exited. Committed buyers haven't arrived. The big players are absent. And their absence is temporary. Quiet signals like this are predictions, where loud spikes are only confirmations. Then, after weeks of compression, a single candle prints below all the equal lows. It pierces the line decisively and looks like the breakdown retail expected. This is what the range was building toward. The sweep does three things at once. It triggers every stop below the lows as market sells, traps the shorts who piled into the apparent breakdown, and harvests panic from longs exiting at the worst time. All that supply gets absorbed by a buyer who is waiting. The candle after the sweep is the single most important volume bar on the chart. Massive volume, the largest green bar across the full width, a big bullish body that doesn't just recover, it drives violently up and breaks clean out of the range. There's no non-institutional explanation for that bar. The pattern to remember: contracted range volume, then a sweep below equal lows, then one high volume breakout candle. After the breakout, the chart prints a clear new higher high above all the range's highs. The structural confirmation that completes the cycle. Character has flipped from range back to bullish trend, a new markup beginning. The chart that chopped sideways for the bulk of its width suddenly has direction again, with momentum qualitatively different from the slow grind before it. 3 things to carry from this chart. Ranges aren't obstacles, they're structures with a purpose, engineered in the way they end. Volume contraction is the quiet clue a range is maturing, more useful than chasing volume spikes. And the equal low pattern shows which side the liquidity sits. The hardest skill here isn't pattern recognition, it's patience inside the boring phase, reading the range without acting on it. If reading charts this way is useful to you, subscribe to SMC Chart Sense for a new chart read every week. That's the best way to keep these in your feed.